What is up, everybody? Welcome to the show. I am coming to you live here from my studio, the Agent Direct offices here in Atlanta, Georgia. My name is Sean Grapevine, director of Agent Direct and number one fan of the man who is joining us this morning from wherever you're joining us from. Where exactly?
Philadelphia.
Philadelphia, PA.
My basement, to be exact.
All right, that's what we're talking about. His mother's basement. He is the man who probably had Bips for breakfast, the one who does best efforts with no effort. We've got here the Colossus of credit, the king of collateralized debt, the Lord of the Locks. Is it a hawk? Is it a dove? Only our resident ornithologist of this jungle of a market can identify them. He's out there with his birding partner, Jerome Powell, who seems to have left the money printer behind. So, gonna need you guys to get back in the office and fire that sucker up because we're not seeing anything we like. Anyway, it's the Austin Koenig, the awesome Austin Koenig.
There we go. Thank you so much,
Welcome.
Sean. Ornithologist is a word that I don't think I knew before last week. To be honest with you, that's something that I didn't cover. I don't think I've ever heard that word, but I believe you when that probably relates to bird watching or something like that. Bird science.
Yeah, it's the study of birds. I was in never mind. I was gonna tell a weird story.
Don't tell on yourself here.
Rob Piclo actually is the one who came up with that little.
There we go.
That little nickname and lead in there. So hat tip to Mr. Rob Piclo, VP of Revenue. Which we could use some more of in the bond market. Look at that segue. Tell us about where we're at, what's happening, what's got you down, what's got you excited.
Yeah, it's been last week we had a CPI print and PPI, and I think without really digging into it too much, I think it was fairly in line with expectations. If we really just want to do a quick summary,
Sure.
With all that being said, like the market has been very soft when it comes to volume and just really a lack of activity. The supply is coming up to the market, by the U.S. issuing debt, and there's not a lot of investor interest. And here's the thing with Wall Street, they have summers are kind of the slow time, especially in August. Late July, August, it becomes kind of slower and things pick back up in September.
Even with all like the algo trading and stuff like that, like that's not just like an old wives' tale or anything like that. We're like there's legitimately less volume and higher bid ask spreads in the summer months still.
Yeah, well, exactly. And the thing is we have to separate stock and bonds between each other, right? So like a lot of algo trading happens on the equity side, and bonds, there's obviously still algo players and all that good stuff. But at the end of the day, there's still natural interest, right? Like, the Fed was the big investor for MBS, right? They're not an
there you go.
algo
That was the
trader.
big algo.
So that's not an algo trader, right? So take the Fed away. Look what happened. There's not enough algo to go and just buy bonds, right?
More like Al left for the summer. Not okay. Anyway,
because think about it like this. You can have an algo trader, but if they don't have money to go and trade a certain strategy, do you have an algo?
No. That's really my issue. It's not so much that I don't know what to do; it's I don't have any money. So I'm with you. I understand. My hearts are with these algorithms.
So at the end of the day, like, and it's kind of just typical, like stereotypical, like Wall Street. There's kind of a slower month or two in the summer where less deals kind of come to fruition. But there is still a lot of deals on the corporate debt issuance side. We don't need to get into all of the deal sheets on corporate bonds and what's being issued, but what supply is kind of getting out there isn't getting super subscribed to. Just there's a lot of things for debt investors to buy, and they're not needing to necessarily chase yields down and make prices go way up. I think it's just generally a weak market, and we're just kind of seeing the implications of that. I wouldn't say the data was anything to write home about, like super good, but it wasn't a bad data print either.
Yeah.
So at the end of the day, we're on track, and I think most people and economists out there, from like kind of the color I'm reading, in terms of we talked about rate cuts before, and that's what kind of what everyone wants to hear about. When's the next cut going to be? Because
Never going to happen.
when's it going to happen, right? A lot of that is being kind of thought about in maybe Q2 of next year. And I know we've kind of pushed that
Their
thing
minds
down
out of their
the
minds.
road. Yeah, but that is what it is.
Yeah, I mean, I'm unfortunately, pretty bearish on bond prices because I just don't see it. I mean, unless there's like, some sort of like something that we don't want to happens. Like rates aren't gonna go down. I mean, there's just no way that they're gonna pull the trigger that easily ever again. So, anyway, I hate to dash anybody's hopes of a refi boom, but the longer we go without a refi boom, the better for us that can stick around and make it work because the crop will be that much more rich if the longer we wait. But yeah, I do see this talk of like rate. It's like what are people even like? Why do they think? Tell me this. Maybe I don't understand. Why do people think the Fed will cut rates in Q1 or Q2? Reduced economic output of the United States economy?
So this is kind of the argument here is, do they need to cut rates, right? Cut rates just for the sake of cutting them? Is that it's kind of been the argument, of some people, it sounds like. But at the end of the day, like the Federal Reserve is there to manage what we talked about really at the beginning of this whole thing, right? It's to normalize prices, kind of make sure that the economy doesn't crash, and like unemployment doesn't get out of hand, right? It's kind of being the stewards of stable economic growth, that doesn't go out of control price wise, but also can make sure that our economy kind of stays number one in a way of like keeping people employed, making sure that there is growth out there, right? But if we, the reason why we were at zero for a long time after the crisis, or right at the beginning of COVID, was to promote growth in times of like, hey, we need the ability to you know, have investing easy to be very cheap to do, right? Like at the end of the day, if you're wanting to start a business right now, that same loan that you're thinking about getting from a bank, let's say, to start your own restaurant, it's a lot more expensive than it was 2, 3 years ago, right? And
Sure.
at the end of the day, you need a better return on that capital. You kind of need a better guaranteed return. Like if you're not going to be able to make a 10% margin, 15% margin, that loan probably won't even get written by the bank, let alone you don't even want to take it because it's like I'm not going to be really making any money
Right.
as a
Right.
business
There's
owner.
no spread. Yeah. Sure.
Correct. So at the end of the day, kind of taking the medicine of higher rates is actually a good thing for the economy in a way of flushing out things that aren't productive uses of capital, right? So think about it like that. Is people that are dead weight essentially, kind of like staying only open for business because rates were really cheap or money was really cheap. That kind of gets flushed out. I don't think that's a huge problem in our economy, but it's definitely prevalent, right? There's
Sure.
probably some businesses that will fail because of that. And
Hmm.
that's probably what needed to happen, to be honest with you. Like you need to flush out the bad and innovate and make the good. And that's kind of a very bold statement, right? Kind of like an economic theory, but that's kind of the way the Federal Reserve looks at it is, hey, we're seeing stable employment, we're seeing inflation come down, but so why do we need to cut rates again? It's one of those things where they just want to kind of keep a promoting stable growth economy, but if it's at a higher cost of capital, that's fine too, because it actually might make the economy better in that sense for growing in the long term and being better. Look at some of the tech companies that blew way up in the stock market and went
Sure.
really high, have come down. There's kind of been the winners that have kind of separated themselves again, but the losers of yeah, this company really never was going to make money in the first
Sure.
place.
I mean,
They've kind of been
look,
kicked to the wayside.
look what's happened in the mortgage market, right? The fittest
Mhm.
survived, and 70% of the rest of the the market has either left or merged or reduced or anything or something like that. So, well, okay, so we've got the successor to Milton Friedman over here, waxing rhapsodic about how he thinks the economy works. Tell us about what you expect this week as far as economic news. Doesn't sound like there's a ton.
I mean, there's just a couple things that come out, like retail sales is released tomorrow morning. Yeah, retail sales, nothing really to note today. There's a consumer inflation expectations. We kind of already got that with the University of Michigan too. I don't expect that to drive the market really. And let alone these are some economic data, some Fed speakers, but housing starts is Wednesday. That can help. That's been a very volatile number recently.
It really
So
has.
what are we going? Does it mean anything? Does it going to push the market one way or another? I really don't know. I'm just kind of curious to see what it's going to be. I mean, we're all in the housing business, so good to know. And then I think Thursday, just the initial jobless claims is kind of the big one there. And Friday's basically zero data. So we're kind of picking at the smaller items here in terms of like the economic significance. But look, we have a slower market, a little bit less volume, just generally what we've seen today and even kind of the end of last week. So we'll see what kind of it gets, traction, what moves the market. Is there going to be kind of a retracing of this leaking higher in yields? Who knows? We're going to kind of play it by ear, but we're all operating the same market. I wouldn't say there's a huge circle this on your calendar. You need a lock before this day if you're worried about this sort of thing. I think it's just like it, lock it, just like it's always been. But some data pieces here and there. But overall, let's just hope for a little bit better market conditions than what we're experiencing so far this morning.
Yes, 100%. Yeah, well, I mean, the good thing is we're seeing I know you guys are adding additional lenders. More players in the mortgage industry are continuing to innovate. In fact, they're being pressed to innovate more and more to earn a bigger slice of a stable or slightly shrinking pie. This morning, Windsor sent out a very teasing email about this new DPA program they're coming out with that looks enticing. And like I said, I know you guys are continuing to add investors, and there's no shortage of investors out there uh, in the retail market, in our market, and it doesn't really seem like house sales are suffering too much as a result of this continuous increase in rate and volatility in the bond market. So, as much as it like if you were just born in 2020, late 2022, you would think that the last 9 months has had an unprecedented level of stability. Rates in the sixes and sevens, not a big deal.
Hmm.
It hasn't moved a lot. It's just important that we don't remember too fondly 2020 and 2021. It was never real to begin with. So, anything exciting happening with you guys in cap markets as far as investors, products, stuff like that?
I'd say one thing that's been pretty exciting that Joy and I've been working on for a while. Joy's our compliance team leader for those viewers who don't know. We are on the final steps of getting an ONAP approval. And for those of you who don't know what ONAP is, it's actually kind of the agency over the Native American products such as the HUD 184 loan.
Cool.
So that, well, not everyone is constantly serving those markets. There's some that are a lot more close to those markets than others.
Sure, sure.
So
I'm
for
sure
those
like our Alaskan loan
correct.
officers would be into it.
100%, and they are definitely the drivers of like making sure that we get that done. And so we're very close to we have the wholesale relationship for that one product now with it's called Chickasaw Community Bank.
Cool.
They're good, but we have to get both things, and we're on the final steps of that. So hopefully, we have some really good news to share here by the end of the month. But it's been a long time coming. So you have to get both, and obviously working with ONEP's a little bit more of a process than just signing up with a wholesale lender, to be honest with you. So,
Sure, sure. Well, that's great. Hopefully that means
all
we've
good
got
things
some
though.
strategic advantage there because it's requires expertise to get signed up. So, well, that's fantastic. I think last week CPI readings came in good, fine. This week we've got maybe housing starts, initial jobless claims, stuff like that, but nothing really that's going to move the market too much. We don't think. Hoping to kind of stem the bleeding here on the 10-year. At some point this week. But hey, if it doesn't, we're still the best option, and your clients still need to live somewhere. So we're in a good place providing housing. Uh,
100%.
Austin, I appreciate your time, appreciate your hard work, and I appreciate all you out there in Mortgage Land's hard work and time as well. I hope you guys have a fantastic day, and I wish upon you 1,000 locks. Have a great day,
Awesome.
everybody. Thanks, Austin.
Thanks everyone. Of course. Thank you.